stay at the top of your game. And that's exactly the same as an economy, right? So knowing that you're not always going to be growing is just part and parcel of, I guess, how things operate.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again for another podcast.
Back again, Andrew. Start of the month, time for a market wrap.
Yes, absolutely. Or start of the month when we're recording, maybe a week into it by the time people start listening to it.
But I can't believe we're in March.
Yeah, the year goes by very quickly. It's insane.
It seems to be going by very, very fast this year. So
yeah, and means that no more summer, no more nice weather. Not that we've had, a whole heap of it in Melbourne, but that's all right.
We might pivot into it because talking about the weather in Melbourne is sometimes depressing.
Depressing topic.
Andrew, lead us in. Obviously, we're starting with the US market because they tend to lead the way right across the world. So what are we looking at with the market wrap for February for the US?
There you go. So I don't know. Did we tell people that we were doing a market wrap?
No, we did.
Okay, there we go. Yeah. I'm just a little bit behind.
Need a coffee, I think.
Yeah, exactly right. So now look, the last month has been pretty interesting or pretty uninteresting from a US market side of things. There hasn't been a huge amount of macro news, but there has been a few movements in markets. So US market has really been holding up very well. I mean, the S&P 500 is up 4.62% in a month, which is unbelievable rates of growth.
Andrew, just repeat that because you said it's been what did you use? The word unremarkable, but 4.62%.
Well, there hasn't been any huge macro news, but yeah, I mean, a rise in the market of 4.6% is huge.
Absolutely.
And so what it's allowed is the US policymakers, and primarily what we're talking about here is the Fed, some time to make some decisions around what they do with interest rate changes. They can, assess the market because there was also some data which Billy will talk about in relation to inflation that came out, which wasn't quite so positive. So it's just given them some time to, just sit tight and assess the data before they make any interest rate decisions.
And I think just calling out too as well, the way that the US Fed sort of operates in comparison, or their market works in comparison to the Australian market, when we think about the interest rate lever being moved up or down, the impact that it has on the housing market. So in Australia, we have variable rates of mortgages, and if we do have fixed rates, and that's a smaller segment of the market, but it's usually for a short period of time, 1 year, 2 years, 5 years generally at the max. Whereas in the US, the fixed rates that you purchase or that you take out when you purchase a home is for the life of the mortgage. So moving the interest rate lever won't have the same impact that it has on, say, Australian mortgage holders, that when the central bank moves over in the US versus the RBA here, where we feel it with our mortgage, they don't feel it. So it's different over there than what it is here. That does give them a little bit more time to be able to assess what those changes look like. But in terms of what inflation looked like for the month of the headline inflation, now this is for the month of January because the data is lagging. So month on month, it's up 0.3%. And what that looks like on a yearly basis, when you extrapolate that out, it's 3.1% year on year. Now, that doesn't sound too bad when we talk about our target inflation rate in Australia between 2 and 3%. But when you look at that at the previous data that we had, it was up 0.2%. So we've moved by up 0.1, and then the year on year was 2.9. Yeah. Whereas now it's 3.1. So
they've had a 0.2% increase year on year in inflation, which in an environment where you're wanting to bring down inflation, and that's generally what the US and everyone else around the world is trying to do, to see a month where inflation has taken an uptick is concerning to say the least. But I mean, obviously markets aren't overly concerned by it given what's or how they've been performing. But it is a concern for inflation, and it shows that it's going to be sticky and it's going to be harder to drop it into that target range.
I guess the other thing that we need to think about, and it's too early to call this, but of the data that comes through from the retailers, because the Christmas time period is generally a more active time. Maybe people are on holiday, so they're spending more money at the shops, whatever it may be. So is there a slight uptick in the data simply because of a seasonality issue? I think that's potentially the case. I guess when we get the data next month, that'll become clear what that looks like. But yeah, that could explain it. You're right. The market doesn't seem to be too concerned by it. In reality, looking at a 4.62% increase for the S&P 500 actually suggests that the market's running quite hot. So maybe that inflation or that the US Fed hasn't done enough to curb inflation yet.
Yeah, exactly. But look, there was a number of Fed members. They came out during the last week or two, and they were emphasizing that, it's important not to overreact to the January CPI data. There was some comments as to, does this mean that that the levers that they're pulling aren't working and they need to go harder? And pretty much every person that was coming out was saying, look, it's nothing to overly be concerned about. It's not a huge uptick, and there could be some, they did mention some seasonality attached to it as well. And generally the market's expecting that, sort of post this discussion, we're looking at, May or June for the first maybe set of rate cuts in the US.
We're talking about a soft landing yet, Andrew, or maybe we'll save that for the Australian market.
Yeah, maybe we'll save that for the Australian market so we can get an Australian sponsor to sponsor the show.
That's it. And we'll talk a little bit about interest rates, the expectation for interest rates as well too, because it's interesting that you pitch that, and we'll put, I guess, our thoughts forward as to what we're expecting to see in the Australian market. But let's pivot away from the US. Let's talk about the poor cousins over in China, because things aren't as rosy as what they used to be.
Yeah, I mean, sentiment continues to be pretty poor in China, primarily in the stock market, but also the property market. And I think the consensus around the world is there's usually limited information that comes out of China. And so when the information that's coming out of China is slightly negative, the expectation is that it's far more negative than what's coming out. It is the general consensus around that. So doesn't paint a rosy picture for our Australasian partners.
So when it's really good news, there's a lot of sugar on top.
Yeah.
But when there's bad news, it's just covered up.
Yeah.
Yeah. Okay. So either way, you're not getting and that's, I guess, look, that's always been the case. Looking at data coming out of China, how reliable and how accurate that is. We'd like to think that it's getting better and better as they become a more established economy. But the Communist Party of China, who knows what they're doing and what they're thinking. But look, on that, I guess in terms of the actions that the Chinese government are taking, and we've spoken about this before on different market wraps, specifically around like their property market and things. But later on in March, the National People's Congress does have their annual meeting. That's a really substantial and big meeting that the world is basically watching to see what they're going to do and how they're going to continue to react and respond to the position that they're in to try and stimulate their economy to get back to an even keel.
Yeah, so the world is watching to see what happens off the back of that. I think another really interesting statistic as well, which does sort of highlight what's happening over in China as well, is that, pre-COVID, Chinese imports into the US were sitting at a bit over 20%. Yeah. And at the moment, or the data from December has come through, and it's at 13.7%. Now, that's roughly back to the same levels of 2004. So you got to go back a fairly long way. Yeah. To see US or see Chinese imports into the US. Now, one, that can be a combination of the political issues that China's having with the US, and two, that can also be a combination of a slowdown in China, and it's realistically probably multifaceted and it's not just one thing. But that is a significant hit to the Chinese economy to, be losing 7% of imports into the US, which is a massive market and by far the biggest market in the world, or one of. So it is a concern for the Chinese economy.
Yeah, it's a big hole to fill. And probably the other thing that I'd add as well too is when you look at, I guess, the US companies that manufacture things overseas, during COVID, so a little bit of a history lesson here, but during COVID, they realized that their supply chains were vulnerable when something happened like a COVID type of event. So a lot of American companies have been bringing their manufacturing back onshore to US soil from overseas, and a lot of that overseas component was being made and manufactured and exported out of China. Yep. So it's probably a combination of all of those things that you've described, plus a little bit of that now. And just looking at the timing, you make that decision as a CEO or whatever it might be. It takes time to bring that back, and actually, the impact starts having or starts shining through on the data that we get access to.
Yeah, exactly.
Change tact, Japan, UK, Germany. Andrew, what's going on over there?
I mean, look, not hugely significant, but is significant really from a world economic perspective. I mean, Japan and the UK, they've dipped into a technical recession. So what that means is if you have 2 periods back to back of negative GDP growth, you're effectively in a recession. And so both Japan and the UK are technically in a recession. Germany also contracted in the fourth quarter of 2023 as well, but the quarter before that they were flat. So it does look like around the world there is some slowdown when you're looking at things both across China, across the UK, across Japan, across Germany. And so there may be a period of time where economically, there is a downtick, or economically there is a recession. And so being fairly cautious around markets. I mean, the share markets, both US, Australian, your large share markets are doing very, very well. But it's important to remain cautiously optimistic on it as well.
Yeah, and I think the thing to call out, I mean, we're talking about, recessions and things, and, soft landing, which we'll interject there a few times so Qantas can sponsor us, but it's a normal part of an economic cycle. And I think that's the thing that we need to keep in mind. And I'm also just positioning that because I'm a Collingwood supporter and we won the grand final last season. And to keep that up and stay at the top of your game, and that's exactly the same as an economy, right? So knowing that you're not always going to be growing is just part and parcel of, I guess, how things operate. So, yeah, that's just me putting that out there, just getting it on the record that expectations are high, but if we don't, it's just a normal part of the football season.
I'm just still stuck on the Collingwood supporter thing. I mean, Billy's going to the dentist after this podcast, so we all know why.
Big smile, Andrew. All teeth. All right, let's get back on track and start talking about the Australian market, because that will probably be the one that I guess interests most of our listeners and our viewers. But we've just gone through earnings season here in Australia. Bit of a mixed bag, which is not overly surprising considering where we're at in the economic cycle. There's no clear themes emerging. I think that's probably an important one. There is some retail data that has come out that suggests that there's probably a tale of two different types of retailers. Either you're traveling okay, or you're starting to feel the slowdown in consumer stuff. But yeah, reporting season across Australia, no clear signal. Bit of a mixed bag. Nothing to.
Yeah, from a macro side of things, there hasn't been any real consistency or huge amount of consistency with it. And retailers, the results suggest that, consumer sentiment still seems to be pretty good, which may influence the RBA to hold rates for longer, coupling with the US, but we'll jump onto rates, sort of shortly. I mean, there's pockets of softness, but again, it's all part of an economic cycle. I mean, to use an example, supermarket sector, price inflation has started to fall, but they haven't had a pickup in volume as a result of it. And so there's been some, issues from not issues, but, a lower profitability than expected in that sector. But there hasn't been any huge thing. The thing that's been interesting is that cost cutting and maintaining your expense side of the balance sheet seems to be a really big theme with most companies at the moment. And really there seemed to be that it's not in restructuring. So normally when you're seeing cost cutting, you're seeing mass redundancies, and sort of, your larger companies are doing a lot of that. We're not seeing a lot of that in the market yet. We're seeing cost cutting on a very, smaller scale.
Yeah, and that's probably I take it as a positive, because ordinarily if businesses are seeing that there's trouble on the horizon, what they'll end up doing is start to basically, how do they cut costs out of the business? And unfortunately, the way to do it is to cut your headcount.
Yeah, well, labour costs are, as a business, one of your largest expense items.
And normally, if that was the case and they could see it, bang, away we'd go. We're not seeing that as yet. Whether or not that transpires, who knows? But we are seeing business owners, I guess, trying to run better businesses by getting their costs and their expenses under control.
Yeah.
So maintaining their profitability and their margins by protecting their profit and loss statement by managing their expenses.
Yeah.
So where that goes, who knows? I mean, that's a good conduit. Andrew, what are we looking at from an unemployment perspective?
Yeah.
What do the numbers tell us?
Well, I mean, look, we've had a very modest rise in unemployment, but it's up to 4.1%. And look, that's the first time that it's gone above 4% since Jan 2022, which was kind of when we started, seeing some issues from an inflation and all of that perspective. But it is starting to show some potential signs of a slowing economy, which in essence is what the it's what the RBA wants. They want the economy to slow down and bring inflation under control. But it is a modest tick in, a modest uptick in unemployment. We're not seeing anything huge or significant there, which is also coming out of the fact that there haven't been any mass redundancies.
Yeah, and let's face it, I mean, we have been at record low levels for a long period of time. So that's an abnormal position to be in as it is anyway. So I don't see this as an issue. I think it's just the economy sort of stabilizing and settling in at a particular level, albeit, we've mentioned this publicly on the podcast before, it was too low anyway.
Yeah.
So seeing an uptick, I think is quite, it's an aspect of a healthy economy.
And look, I've been just thinking about it, to be perfectly honest, and, I don't know exactly what that data is, but a portion of that is also going to be in that, we've had a significant amount of migration into Australia. We've opened our borders and allowed, a significant number of people into an economy. And so just because unemployment has taken an uptick, it doesn't necessarily mean that there's been job losses or that people have lost their jobs.
Yep.
It can also be a population growth. And as a result of it, the growth in population hasn't been, fully employed just yet. And as a result, there's an uptick in unemployment as well.
And I guess on that note, we've seen the ASX up 1.46% for the month of Feb, which has been good. So if you extrapolate that out, that's a really solid growth for 12 months. Really simplistic way of looking at it, but 1.46, to put it into context, is a great result.
Yeah. So I mean, both share markets, when you're looking at Australia and US, are holding up well and are reacting positively to data. But Bills, what's the expectation around interest rates?
So I was going to say two things. Are we going to achieve a soft landing, and where's the expectation for interest rates? So from an interest rate perspective, just sort of casting back to your comments before around what the US is going to do, I think from an Australian perspective, it's always fair to say that we follow what the US market does. So if the US is and we're usually about 6 months behind. So if the US is talking rate cuts around the middle of the year, then I think it's not going to be as early. And this is starting to come through when you're listening to different economists talk. It's not going to be as early as what everybody was either hoping for or expecting. And some economists are coming out and saying, actually, we're not going to see any rate movements in 2024. I mean, that's a big call considering we're only relatively at the start of the year. But yeah, I think from that perspective, there's not going to be a lot to see, I don't think, unless something comes completely out of left field, where the government needs to pivot again and do that. But at the moment, the Reserve Bank, especially because there's a new governor in the seat, they cannot get this wrong. Yeah. They need to be very careful. They can't put out statements that are outlandish and stuff. They need to be really disciplined around their thinking with it. There's a lot more scrutiny in terms of how the RBA, the governance of the RBA has been structured. There's a lot more transparency involved as well too. So I think from their perspective, their finger is on the pulse a lot better than what it has been in the past, and they're not going to be in a rush to do it.
Yeah, exactly. I think that's the key point is they're not in a rush. And while a lot of home borrowers are sitting there and they're in a rush for the RBA to reduce rates, they're not. They want to sit tight. They want to make sure that the levers that they've pulled are going to result in the desired outcome, rather than pulling it too early and trying to rein it back in is, almost impossible. Not almost impossible, but it paints a far more bleak picture, which, I mean, to come to your second point is, are we going to achieve a soft landing?
Qantas.
Every time I say soft landing.
Qantas.
or maybe we're just giving them too much free stuff, which is why they're not sponsoring us. So the general consensus is, and I think that looking at it in are we going to go through a recession or are we not going to go through a recession, is probably too black and white and doesn't really capture enough nuance. The expectation is that, look, the economy is holding up better than what we expected, so it's more likely that we're not going to go into a recession than what it was previously. But the expectation is that if we do go into a recession, it's going to be far shallower and far shorter than where things were initially expected. So looking at it in a simplistic view of recession, yes or no, doesn't quite capture the fact that even if there is a recession, even if there is an economic slowdown, it's going to be, or the expectation is that it will be far shorter, will be far shallower, and will be in a recovery period before where we initially expected it to be, which does paint a far nicer picture in the economy, and it looks like things are holding up well despite the pressure that's ultimately being put on people.
So just to get the sponsorship in there one more time, I'm going to call it as a soft landing.
Qantas.
Andrew, thank you for today's podcast. Always a pleasure. To our listeners and our viewers, hope you got a whole heap out of today's podcast. Don't forget to like and subscribe, and look forward to catching you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.